After natural gas recently witnessed the formation of this falling wedge, we are now seeing this bullish breakout to the upside, forming out higher highs and higher lows. We've also seen that coincide to this divergence here happening to cumulative volume delta, which has shown you bullish aggression growing in the last few days. And so we are building out this new trend. We are building out this reversal quite beautifully right here. We are retesting this resistance at around $3.25 right now. We're seeing this high volume area, which has been actually an area of a lot of volume here recently as we've transitioned here in this falling wedge. And so we're currently retesting really important levels. But whether we're about to see this actually end in a long-term bullish trend here to the upside, we can only answer that by not only taking a look at those technicals, but also at the fundamentals, macroeconomics, and geopolitics. And so let's have a look at some supply and demand data and obviously also at the geopolitics that are currently impacting LNG prices. Because obviously the Strait of Hormuz is currently being closed, and we're seeing that the total volume of LNG transiting the strait was just over 112 billion cubic meters in 2025. And so that does obviously lead to supply disruptions because that is making up around 20% of global LNG trade. Now that is having a massive impact on the natural gas markets, but especially on the Asian markets because they are the main destination of Qatari and UAE LNG. And so almost 90% of the total volumes exported via the Strait of Hormuz are actually destined to Asia. And Europe is just making up 10%. So the Asian markets really seem to be heavily impacted, especially Pakistan, India, and Bangladesh, but also obviously China. And that is why we're currently seeing China talking with Iran to allow crude oil and Qatari liquefied natural gas vessels safe passage through the strait. And this is currently what is happening here with geopolitics. The USA actually saved this supply disruption by entering Venezuela and actually supplying the US with Venezuelan oil right now. And now after that, we've seen this invasion here with Iran and this war happening in the Middle East. And so obviously China is massively impacted. The US maybe not so much, but we are still seeing LNG prices in the US also going to the upside. And in fact, also crude oil prices are currently surging to the upside. But to put it into perspective, we do believe this is rather a short-term supply disruption. A long-term bullish trend might not be started right now. And why we believe that is what we're about to discuss in the next few minutes, because we are going to have a look at the most important cycles that natural gas faced in the last few years and decades. And so if you don't want to miss those videos in the future, don't hesitate to subscribe to our channel and hit the like button so you support us and don't miss those videos in the future. And also check out our Discord server and ask some questions if you have them down in the comments, or just give us your opinions. Thanks for your support. Now let's have a look at the weekly here at natural gas. And what you do see is we've marked those recent lows that we've seen in the last few cycles. They've always actually coincided to be in a certain time period. Obviously, it does vary, but we do tend to see those cycles with massive drops, massive sell-offs here happening. For example, here in 28 with the great financial crisis, we've seen a massive sell-off. But also here previous to the COVID crash, for example, we've seen a massive sell-off happening. And they also tend to coincide to recessions quite often. But they can also happen besides a recession is actually happening. Now let's have a look at the copper to gold ratio, the gold to silver ratio, and also the gold to S&P 500 ratio to understand those cycles more. What you can see is we tend to see divergences between the copper to gold ratio and natural gas before massive crashes happen here with natural gas. We've seen that divergence happening here previous to the great financial crisis, where we've seen natural gas actually rally to the upside, while the copper to gold ratio has always or already showed some weakness here previous to the crash. We've seen that actually reverse or actually happen again. here with this scenario. For example, in 2011, we've seen natural gas prices move higher. We've seen the copper to gold ratio move down. In other words, whenever this ratio is moving down, that is just showing you gold is outperforming copper. And that is usually happening when times of economic stress are also occurring. And that is exactly what we like to take a look at. We like to take a look at those fundamental sentiment indicators that are showing you whether the sentiment is currently risk on or risk off. And whenever we've seen those divergences happening, where we've seen this last inflationary boom happening with the cycles coinciding to this risk off environment actually starting off. In other words, when we've seen this flight to safety happening, that actually marked a lot of beginnings of those sell-offs or maybe even crashes that we've seen following. And as we're currently seeing that divergence happening once again, you may understand why this ratio is so important. And this may also indicate that we could see another push here to the upside, another breakout to the upside, another bullish trend to the upside, but that this may not be so long-lived, as we might see history repeat once again, that we do see this ratio here to fall even more, fall off a cliff, as we've seen, for example, happening here in 28, and this natural gas also going down here. But let's have a look at the gold to silver ratio to underline this thesis. And as you do see, we are often seeing those reversals at the gold to silver ratio. And in fact, it's quite similar to this ratio, the copper to gold ratio, because obviously gold tends to outperform silver in risk off environments, and silver tends to outperform gold in risk on environments. And so whenever we've seen this reversal from this weakening to this strengthening trend here at the gold to silver ratio, that actually marked many crashes that we've seen happening. For example, also here in 2011 and 2012, we've seen that weakening trend at the gold to silver ratio and then this strengthening. And obviously, we do have seen that many times throughout history, but it's currently happening once again. We have seen that massive weakening trend at the gold to silver ratio. We've seen that reversal probably happened already, and this may already be the beginning of this new upwards trend, this upwards spike that tends to happen when economic stress is also happening in the markets. Now let's have a look at the gold to S&P 500 ratio, because this is ultimately one of the most important indicators that we at Chronos watch. It shows you whether the S&P is outperforming gold or whether gold is outperforming the S&P. And whenever this ratio is rising to the upside, that means gold is actually outperforming the stock market. And historically, whenever that actually happened, we've seen this being a signal for crashes at natural gas as well. We've seen it happen here in 27 and 28. As this ratio slowly began to rise, we've actually seen this crash happening just afterwards. We've seen it also happen here in 2011. We've seen it also happen here in 2015, in 2020, and also here in 2023. And so whenever we just do see those slight spikes here to the upside, or sometimes even bigger trends, that tends to actually beautifully indicate those economic crises and those sell-offs here at natural gas. And in fact, we are currently seeing this ratio rising again, and that is just one of those other signals that we are currently seeing at Chronos that would actually indicate a deeper sell-off happening to natural gas in the next few months. Now, in the short term, we remain bullish at Chronos. We do believe that this is the start of a longer term trend here to the upside, but we do believe it's limited in time. We do believe it will not actually take much longer than a few months, since since we've just assessed this deflationary crash data. We do believe we do see a deflationary crash that can also be short-term lived, but we definitely expect that to happen in 2026. And so a possible scenario could actually be that we do see this kind of inflationary boom, as we are seeing those supply disruptions here in the Middle East. We could see this kind of inflationary boom to take some time. We do not obviously are able to predict whether we're about to go just to the upper band of this long-term trend or maybe even above. Whatever happens, we expect to see a deeper market correction here in 2026, and so this is our ultimate primary scenario here at Chronos. If you have any questions on that, please don't hesitate to ask them down below in the comments. Also, just give us your opinion on the topics down in the comments. Thanks for your support. See you the next time. Bye bye.